Right. Let's get to that big move in rates today, because it was a big move on the 10-year yield. The yield there touching 4.7%, highest level since the end of April. The move coming after the latest ISM services data came in hotter than expected. The spread between 10 and 2 years, now the highest since May of 2022. So fears about inflation are remaining out there as something for the markets to grapple with.
So we've all talked about this. And if you have higher rates because of growth, and you're looking at, there's a reason why you have higher rates. There's a bullish reason, there's a bearish reason. But we all have to remember, QT is still going on, and QT is still supportive of rates. So you can't have cutting and QT on the other side. That's a push-pull or a tug of war. So I think the market is on pace to see QT end in March. That's where you could see rates sort of come back in again.
I think that we should be talking about rates today. I mean, if you think about a 10-year auction where this auction, by the way, was came out, it was fine. It was a non-event in a world where it could have been eventful. And yet we printed the highest yield since 2007. It's the first auction that's printed that high since 2007. We know back in April, 470 was the close. And that was the close to watch for today. And I think we're going to get there. I mean, ISM services, we know that's the biggest part of our economy, was robust. The dynamics around the technical components, though, and I think that's the part of this that, you know, I think Steve's also referring to. It's not just about growth. It's not just about inflation. I mean, there are technical components here. And when we think about, again, the administration's, what they've articulated in terms of policies, whether they're going to be, and we've walked back tariffs and this and that, it is something that I think puts upward pressure on rates. Trump out there also saying rates are
too high.
Far too high, is what I heard. Not too high. So.
Right. But we are in a different place in terms, I mean, if we are worried about inflation, you know, remaining out there, the Fed is on a cutting path. They may be paused for a while, but we know that the next move is most likely a cut by the Fed. So isn't that different? It's a different prism through which to look at this move in rates. No, Karen? I mean, are you concerned about this, or is this going to be?
I am concerned. I think the Fed, what are we at now? 2 cuts is most likely.
Yeah.
1.5.
In. And I was going to say, they don't seem to be so committed to that. So it gets back to your point, though. Is it inflation for the good reasons or not? I think one of the things that we don't have a good handle on yet is productivity gains. If that can help, that could be the sort of, I don't want to say magic bullet, but that could help. Although I am concerned, we talk about it all the time, about this potential tail risk of a terrible auction and getting into a crisis.
Don't you have a Powell put again? If things get worse, don't you have the ability to cut rates in a more aggressive fashion? We saw it in September.
In what way? If we get higher
unemployment,
higher inflation,
they can't.
But inflation comes from 2 things right now. It's energy and shelter costs, and the shelter cost seems like a cyclical battle because you need rates to come down for shelter costs to come down. But energy, I think, will come down. So that'll be half of it.
I think it's services. And again, the ISM is what has people worried. I mean, if you think about some of the prints that we've been getting, and when you look at some of the regional Fed surveys, when you listen to companies, it's not that there's a scarcity of jobs. It's that the wages and those dynamics. We have a big payroll number on Friday. I think wages are probably going to be kind of flat, coming in at 0.3% or something. You know, but I do think that this is the part that we can't really handicap here. That's not coming down. They've been very sluggish.